This is something that a command and control economy and government can do to stimulate its economy that doesn't necessarily happen with an independent central bank like the Fed. What does this signal about what China feels about its own economy, the fact that they are now cutting interest rates?
Well, that's right, Dom. It is a centrally controlled economy, and so they can implement these stimulus measures. The context here is that we've been talking about hard landing or soft landing in China for over 8 years now. We know they've been slowing down. We've seen that not just in the government reported numbers, but also in other indices. And if you think back to what happened in 2015, 2016, when with that last bout of big volatility, we thought China was really going to potentially hit a hard landing. You had a lot of stimulus come out of the Chinese government at that time as well. So this is very much in their playbook. I think the broader picture for markets is that if investors and economists thought that central banks will kind of go quietly into the night in terms of tapering down stimulus. That's probably not the case. Central banks are still very relevant here. We're talking about the Fed every day. Obviously, the PBOC is still very much a factor. It's going to be a process before we can unwind a lot of the stimulus that's happened over the last 10 years.
How important the Chinese economy, or the perception of a slowing, or maybe not even perception, we've seen some data that shows a slowdown in the Chinese economy. Is that pretty much what's driving the market volatility over the past couple of weeks into 2019? It was concerned about the Fed and rates for a while earlier this fall, but it seems as though it's shifted a bit more to emphasize the Chinese economy situation, as evidenced by Apple and the reaction yesterday.
Well, I think that's certainly true yesterday, especially with Apple, as you point out. But the issue of the Chinese economy, it's really just one piece of the puzzle. The global economy, unfortunately, it does look like it is losing some steam. And that's certainly true not just in China, but rest of the emerging markets, developed markets, and also in the US. We had that ISM report yesterday that showed that things were decelerating. So that's the bad news. And the market is certainly in the right direction in terms of how it's perceiving that. The good news, though, is that we think the market is probably overreacting here. Things are decelerating, but we're not in negative territory in terms of growth rates by any stretch of the imagination anywhere in the world. Things that people are worried about, like the yield curve inverting. The yield curve has not yet inverted. People are worried about the Fed over-tightening. The Fed has not yet over-tightened. And so the market seems to be directionally correct in terms of things decelerating, but we are not yet in negative territory, and so it's probably too pessimistic right now.
All right, so given that scenario that you've laid out, what exactly is the strategy? Because prices have come down markedly over the course of the past few months. So what is the strategy then? How do you position yourselves to either benefit or play defense against some of those outcomes that you're talking about?
That's right. So it is a difficult market environment because you're seeing a lot of volatility, big pullbacks in the market, big swings every single day. We think the best strategy here is still to stay balanced because we're later in the cycle. There's no doubt about that. The fact that we're decelerating is very much a symptom of the fact that we're, in the 10th year of both the bull market and the economic expansion at this point. But we still think that if earnings growth can continue, even at a 5, 6, 7% pace, we can actually still see decent returns in 2019, both in the US and abroad. So we would urge investors, especially everyday investors, to stay balanced in this environment and basically take that market volatility in perspective.